It's a whole lot of money I'm sorry, y'all, but listen, it's a whole lot of money involved in selling property, and when that happens, the IRS definitely wants their cut, and that cut is called capital gains tax. Let's get into it. It's your girl, Jessi Nicolette, realtor and accountant in the Atlanta, Georgia area. Thank you for tuning in to Let's Talk. If you're new to the channel, we talk real estate, building wealth, and living our best lives. So if you're down to talk, go ahead and hit the subscribe button and make sure to turn on your notifications because you don't want to miss what we have in store. And please do me a favor and share this video so we can spread this information and grow the channel. Before we start, I want you to know that I'm a licensed realtor and accountant in the Atlanta metropolitan area, and I would love to earn your business. Click the link below to schedule a consultation with me. Now, with that being said, let's talk. Let's break down the capital gains tax on real estate transactions to help you understand what they are and minimize any taxes you might owe. So, what exactly is capital gains tax? The capital gains tax is a tax on capital assets like homes, stocks, bonds, and other types of assets. Now, you only can obtain capital gains tax when you realize a gain. For example, if you bought a home and that home appreciated by $100,000, you would not pay any capital gains taxes based on the fact that your home simply appreciated, right? But when you sell your home, then you realize the gain and would be subject to capital gains. So basically, you're only assessed a capital gains tax when you sell your assets, and you would only pay capital gains tax on the difference of the purchase price you paid for your real estate and the sales price. For example, if you bought a home for $400,000 and later sold it for $500,000, you would only have to pay capital gain taxes on the difference of the $100,000. So there's two types of capital gains taxes, which include short-term and long-term capital gains. A short-term capital gain tax is assessed when you sell a piece of property that you own for less than 1 year. And on the other hand, you have a long-term capital gains tax, which is assessed when you sell a piece of property that you've owned for a greater amount of time, right? So short-term capital gains are taxed as a part of your ordinary income, which means you would pay ordinary income taxes on the sale of your real estate based on the tax bracket that your income places you in, right? Stay with me, y'all. For example, if your income puts you in the 20% tax bracket, your capital gains tax will be taxed at 20% as well, right? So, long-term capital gains, on the other hand, are taxed differently. It's still based on your income to some, but the taxes are limited up to 20%. So for example, if you're single and earn over $400,000 but less than $430,000, then your capital gain tax would only be 15%. As you can see here, long-term capital gains are more favorable in the terms of tax treatment. In this example, the difference of the 15% on the $100,000 capital gain would save you $15,000 if you're in the 30% tax bracket, right? But what if you want to avoid this tax altogether? Fortunately, there are a couple of ways to minimize or avoid these taxes altogether. The first tax strategy is Section 121 exclusion. Now, this tax strategy is for people who are trying to sell their primary residences. Section 121 of the tax code allows homeowners to exclude a portion of their capital gains when they sell their primary residence. So if you're single, you can exclude up to $250,000 of the capital gain. If you're married, you can double this and exclude up to $500,000 of the capital gain. Now, there are a couple of requirements here that you have to be aware of. The main requirement is that you must have lived in the residence for a minimum of 2 years during the most recent 5-year period. So if you only lived in the residence for 1 year, you would not qualify for this exclusion. But on the other hand, let's say you lived in the residence for 1 year, rented it out for 2 years, and then you returned to live in it for another year, then you would qualify in that scenario. See, the 2 years you lived in the residence does not have to be consecutive, but you do have to have lived there for 2 years. So Tax strategy number 2 is one of my favorites, 1031 tax exchange. This tax strategy is used by real estate investors to defer capital gains and build wealth. Now, a 1031 exchange is a swap of one investment property for another investment property. So basically, it allows you as the investor to sell one of your properties and subsequently acquire another investment property without realizing any capital gains. Now, we have an entire video on the 1031 tax exchange, so make sure you check out the link above, okay? Because the 1031 tax exchange is one of my favorite tax strategies. Remember, if you're interested in building wealth, creating a legacy, or generating passive income, investing in real estate is a great starting point. I would love to be a part of your journey. If you need help buying or selling real estate in the Atlanta metropolitan area, or if you need help with accounting services, please click the link below to schedule a free consultation with me today. That is all I have for you guys. Thank you so much for tuning in. Please remember to subscribe and hit the notification button so you don't miss out on anything, and share this video with all of your boss friends. I'm Jessi. I'm signing out, and I'll see you next time.